So what I want to talk about today is 3 industrial risks that you want to look out for. A lot of times, everyone will tell you, listen, industrial, that's the way to go. A lot less risk, a lot less management. So that could be the case, but let's dig into this a little bit and let's just kind of see what's there. So the first thing I notice in an industrial property, increasing value is tough. It really is. And I'll give you an example here. Let's say you have a warehouse and you have a shipping company, whatever, a UPS center or something is there. They typically sign a long 15-year, maybe 20-year lease. It's not a long deal, right? The problem is in commercial real estate, the leases generally go up 3% a year. That's kind of how they increase. Now, this could be great for long-term cash flow, sustainability, absolute net deals. Fantastic. The issue comes when the market is moving up at an accelerated pace and you really can't raise your rents or do anything. You're kind of stuck there. That's a big risk sometimes. So when you see a long-term deal, just kind of evaluate that a little bit and ask yourself, are you able to catch up with everything else? There's been a few times I've seen clients have this problem, right? Where they'll see a nice property and they have a long 10-year deal on it. And for the first 4 or 5 years, the market is really going crazy and they really can't, cash in on those rewards. They have to wait because you just can't terminate someone's lease. And now the problem is, it's kind of what we go back to, right? There's only 2 ways to make money out of this. And one of the ways is selling. Well, the issue comes in if you're selling a property with a shorter term lease on it, in warehouse, industrial, not very good, not very good. People don't generally look at that as favorable. Banks need more than 2 years. If you don't have at least 2 years, they don't like the looks of that deal anyway. How would I phrase this for you? The credit is primarily based on the tenant, right? So the strength of the tenant is the strength of your deal. You don't matter so much. People always say they do, and small banks will say, hey, we want to look at the relationship, we want to look at the borrower. No, they don't. Don't believe that. It's a bunch of nonsense. They care about the deal. And if you talk to a lot of banks, a lot of them will say that. A lot of the smaller banks, right? What do they always say? Relationship, relationship. Don't waste your time with those guys. The bottom line is the deal has to make sense. The only time the relationship matters is if the borrower has a whole ton of money and the deal sucks. That's when they'll look at it the other way. Bottom line is banks want to protect themselves. And if the deal's really good, they know their risk factor diminishes. Now, if the credit tenant has a 10-year deal, the good news is that refinance, it's pretty much a done deal, right? Because, hey, they've seen history, the guy's been there for I don't know how long, you want to pull some cash out of the deal, it's great. So it's a double-edged sword. It could be very, very good, but if you're trying to grow your capital and really get out there, it's one thing. If you're trying to preserve wealth, it's another play. So you kind of have to look at it both ways. You have to look at what you're looking for. The biggest thing I want to mention on this, liquid is a challenge when you're industrial. And I say liquid is a challenge because getting cash out of your deal is very, very tough, right? You have to sell or you have to refi. Well, if rates aren't good, if things aren't stable, whatever the case is, you're kind of stuck. If you want to sell, you got to have a certain amount on the deal. If it's a property that you're selling and you know the tenant is leaving, no one's really interested in that. So you kind of have to look at all things. Everybody says industrial is the best, but sometimes it can't be. It's not. Now I'm talking about single tenant, right? Maybe if you want to get into storage facilities, a little bit different. Maybe if you want to look at flex space, it could be a little bit different. But regardless, you want to look at the 3 things you want to keep your eyes on are increasing the value, right? So that's number 1. How do you increase the value? That's usually a risk depending on the property, on the term, the contract, all that fun stuff. Number two is credit, right? We talked about credit. The credit of the tenant, not you. They don't really look at you. It's the credit of the tenant, the credit of the lease, the strength of it. And then the third one is how can you cash out of that asset? So as long as you look at those three things, you're going to be in really good shape. Because the thing people don't mention to you is it's very difficult to find a tenant for a vacant industrial building. That's kind of the challenge there. It doesn't sit there for like an apartment for 30 days. No, you could be sitting there for a while to find the right person in there. That's very, very challenging. So I hope that was helpful. I hope you guys enjoyed that. Let me know if you have any questions.